Okay, so good morning, everyone. My name is Ayelet Perlstein. I lead investor relations for IFC. I'm also a member of the XCOM and very happy and proud to have been reelected. Today, we would talk about how the principles support specific markets, and we would be focusing more on the emerging market angle. Let me start by thanking my panelists and asking each of you to briefly introduce yourselves. Manuel, please.
Okay. My name is Manuel Valdez. I'm Director of Debt Capital Markets and Derivatives at CAF, pretty much in charge of the whole funding plan for the institution.
Hi, good morning, everyone. I'm Rachel Smith. I'm a fixed income sustainability and portfolio specialist at Morgan Stanley Investment Management.
Good afternoon, everyone. My name is Nkrumah. I'm Managing Director for Access Bank Ghana, a bank in Africa in about 15 countries. I also doubled as the chairman of the Ghana Stock Exchange.
Hello, everyone. I'm Amaury Mulliez. I'm head of the country risk and sovereign risk assessment at the French Development Agency.
Thank you so much. So, kind of starting maybe with you, Pearl, who has the best perspective on the ground and wearing both of your hats, both from Access Bank Ghana and the stock exchange. How useful have the principles been in mobilizing capital on the ground to sustainable projects?
That's interesting. I didn't think I was going to be the first. So on that question, especially wearing an issuer hat and also a governance hat. So from an issuer perspective, as Access Bank Group, we were the first African bank corporate to actually issue a green bond in 2019. And for me, I think what the principles did at that time and continue to guide is the common language that it provided for a bank in Africa, in Nigeria, that is trying to issue a green bond that is looking for investors across Africa and the world. So is that common framework, common language, common perspective, common reporting, and guidelines that is what the principle provided. And I must say that the success of it was the fact that we're not rewriting the language. It existed already. And we could actually establish a common ground for us to be able to achieve what we were looking for. And it was quite successful. So this was about $41 million, quite small. But at least what we wanted to use it for and the impact we wanted to create, that we still, though it was 2019, we're still benefiting from that. As a bank, it also helped us to come up with our own green bond framework that governs the 15 countries that we are present. So any other country that wants to take advantage of that, we have that framework established. The second thing it did for us as a bank is called our sustainability framework, as various countries and government across various countries started asking for certain disclosures and certain guidelines. We had taken steps around that, and this is what we currently use to guide the entire 15 countries that we are present. Our environmental risk assessment, our ESG principles, we take a lot of cue from the ICMA principles at this. Coming back to the Ghana Stock Exchange, in 2022, the Stock Exchange issued a disclosure guidelines that said every issuer and every player who is on the stock exchange, in terms of reporting, in terms of governance, must disclose how they are exhibiting the sustainability principles and how they are introducing the sustainability principles in their financing and in their business. Hence, the reporting that has to be done every year in the Ghana Stock Exchange had to have that. So that from a disclosure, a reporting, and a governance perspective is also there. Thank you.
Thank you so much. And kind of maybe turning to the investor perspective, so Rachel, over to you. How important or what role do the principles play when you assess sustainable bonds in emerging markets? And how important are they when you assess the bond? And how important is also the assessment of the issuer? So maybe you could talk a little bit about that.
Yeah, definitely. The principles are really important and fundamental to our investment process because they give us a lot of confidence that the foundations of the framework are there. That really means that we spend a lot less time re-evaluating and revalidating all of the underlying technical aspects of the issuance, and we can spend a lot more time actually evaluating materiality, additionality of the proceeds, and focus our attention in a better way. In the emerging markets context, I think the principles are really important for standardization. We've heard a lot today that it's not a rigid framework, it's not about being prescriptive, but it's more about setting principles that all global issuers can actually try and follow. And I think the principles are really valuable in the EM context to allow for some of that standardization. To your second comment on issuer versus issuance, I definitely would say issuance is only half of the story. We place a lot of emphasis on the issuer level, and we've also heard quite a lot of that today, actually. I think it's a really critical point, and we try and account for this in the EM context in our sovereign scoring methodology, where we really try and remove some of the bias that's historically been against emerging markets by adjusting our scores by GDP per capita. So we try and take that into account at the issuer level, but it's definitely something that can drive allocation if we don't see both the issuer and the issuance performing to a certain sustainability standard. We've had this previously in the case of LATAM Sovereign that had a very strong sustainable bond framework, very robust geospatial and social gap criteria, really strong investor communication as well, all of the underlying capabilities of a strong framework, but actually at the issuer level, there was a retrogressive climate action path, and there were a lot of roadblocks to renewable energy development. And that actually meant that we were unable to allocate to that particular issuance in our sustainable strategy. So it's really a combination and thinking about marrying both the issuer and issuance level analysis.
Thank you. Maybe also turning to you, Amaury, how important is, we're talking about the issuer level, how important is still the analysis of the macroeconomics, the fundamentals, the risk, versus the sustainability credentials when we're talking, bond by bond in emerging markets?
Yes, so we do believe that indeed the risk and the macro fundamentals remain the key issue. When you look at the data of sovereign bonds, and actually all that I will cite today comes from our colleagues from Natixis, if anybody in the room, so thanks to them. I think that the global volume of labeled bond today in the sovereign area is about a bit more than 500 billion, at least from data coming from 2022 and to now on. 80% comes from advanced economies, so a robust macroeconomics most of the time. And in the emerging market bracket, you also get nearly 80 to 90% of investment grade or near investment grade countries. So clearly, labeled bonds is not the solution for issuers that would have some poor risk or macro indicators. One exception may be Honduras, that came on the bond markets thanks to a labeled bond, but that was really more of an exception. The second hint that says that, according to me, the risk and macro is still the most important criteria, is the fact that the share of labeled bonds in emerging market has not grown linearly over the past years. It was 15% penetration rate in 2023. It fell down to 8% this year. It was even 5% in 2025. clearly, if that was the key factor, I think we would see a more linear growth. Now, switching to the investors' side, I think that probably one criteria is, in fact, are you European or not? On the sovereign bond market, US dollar is really prevailing most of the time. On the label bond, segment, it's the opposite. At least for the past 2 to 3 years, it used to be a still a US dominated segment, but it's not anymore. So clearly, the demand is more coming from Europe, and that's probably one of the key drivers. Now, one last message, maybe to mitigate a bit what I've just said, is that at least at our level, we try to assess sovereign risk and country risk for our internal financing purpose. We've now included climate risk and even biodiversity risk, and of course the social dimension was in the country risk had been there for a long time. What we see is that in fact there is not so much discrepancy between emerging markets and emerging governments that are able to have good sustainable indicators and those that have good macroeconomics. So in the end, probably also you get a kind of convergence between these criteria.
Thank you. And Manuel, over to you. We've heard a little bit about the regional context. So emerging markets is not one market, right? It's many regional markets. You operate CAF both in local markets and regional markets. Do you see a difference there, both in terms of how the principles are looked at, both in terms of the investor appetite and demand? How do you compare the two?
Sure, and thank you for the question. So in CAF's case, for us, the principles are kind of the common language that allows us to connect global capital with local impact. I do see two distinct roles. So for example, for global markets, the principles provide consistency, comparable, and confidence to investors. While in the case, and we clearly see this, for example, since the creation of our multiple frameworks, especially our most recent new sustainability framework that we published last year, we have seen an increase in investor diversification. Now, in the case of local markets, the role of the principles is more of a developing market tool. So for first-time issuers, regulators, even local investors, the principles can work as a structure, or a globally recognized structure, for them to participate in this market. A recent example, for example, is the city of Bogota issuing its first green bond. In that specific example, the role of the MDB was slightly different from what we're accustomed in, meaning that you usually see MDBs developing these type of markets as an issuer, but in this case, specifically CAF as well as IFC participated as an investor anchor. And the principles in that transaction helped structuring the trade, the framework, et cetera.
Thank you. Maybe turning again to the investor side, and Rachel, you'd be representing that for us today, but we've talked about the role of the principals, so you all mentioned that they've been very supportive. Still, we don't see a growth in issuances in emerging markets that matches the development needs. We had a Slido survey yesterday, and there was a large majority who thought it was investor demand. Could you talk a little bit about what is hindering larger investor demand, larger allocations into these bonds? Is it reporting? Is it frameworks, risk? What are you looking at?
I was actually going to say I don't think it's investor appetite or a lack of investor appetite.
Okay, that's valid also.
I think there's definitely a lot of that still, and if there's many investors here, and I'm sure everyone would kind of say the same thing, that we're still very much interested in these issuances and building diversified portfolios with compelling sustainability outcomes. I think there's a lot of opportunities in emerging markets to really have strong additionality in the projects, and that's something as investors that we're really looking for. I think if there are areas for or opportunities for improvement here, I think it's making the link between the issuer level sustainability strategy and the issuance. I think that, as I mentioned earlier, has prevented us from making allocations in the past. And when that's really clear, those types of sustainable bonds stand out. We've seen that in the emerging market space with a LATAM state-owned bank recently issuing a nature bond using the ICMA Nature Practitioners Guide, really leveraging that guidance to build a very robust set of projects, but also not only having the projects, also having a strong overall sustainability strategy ahead of peers, setting nature commitments. And so we can actually really make the connection between how the projects will end up benefiting the overall sustainability strategy. And that type of labeled bond is really beneficial for us to include in our sustainable debt strategies. So I think that's one key area where we can potentially see more allocations if that type of thing improves. The other area is impact reporting, which can, of course, be very difficult in these types of markets. We understand there are issues with data collection, and what we don't want to do as investors or as a community in itself is set the bar too high that we prevent some of these first-time issuers that we often see in emerging markets actually coming to the market. And I think that's one of the positive things about the principles is it's not trying to be a barrier, it's trying to set non-prescriptive guidelines on how these issuers can come to the market. Aligning as much as possible with the impact reporting guidance, the updated impact reporting guidance, is really beneficial to us as investors. We understand that sometimes that's a bit difficult, and we do have leeway sometimes for these types of EM issuers, but alignment as much as possible will help drive some of these allocations going forward.
Pearl, over to you. What do you think are the biggest barriers to growing this market to match also Africa's current development needs, but also what are the opportunities that other issuers might be missing?
Thank you. And I think I will just add on to what you just said, but probably provide a bit more context because it's not, when we talk reporting, in Africa, we are not asking that we shouldn't give an impact report. But if you, for instance, I'll use a country like Ghana. Address system, zoning system, it's not coherent. It's virtually non-existent. So if I really want to use some of these impact reporting guidelines, it will be very difficult to get it clearly that this is how funds have been deployed and the impact that has come out of it. So I will look at it from maybe 3 perspectives. And like you mentioned, it's not lack of demand or lack of supply. Obviously, Africa has an infrastructure gap of about 108 billion every year. So it's needed. Financing is quite expensive. So debt, we're heavily dependent on debt, which is not patient. So bonds like this is also very important. But the accessibility is a problem, and which comes from verification process and the process that you don't have time and patience to do. So the best thing that will be, for instance, if I look at Ghana Stock Exchange, most of the companies that go, corporates that go to the stock exchange to raise funds, it's just the vanilla funds raising. However, it might be deployed into things that they believe will help them as a corporate to save money. But it will not be done from a sustainability fund, a social fund, bond, or a green bond. And it's just because of the process and the verification. So there are no different process in terms of, because you are opening this to the larger market, it's just not restricted to Africa. The investors might be from France, so you have to get the same guidelines and principle. And for me, that is what most of the issuers really do not take advantage of. And it's just because of the verification process. Then the data collection process, as she mentioned. I've mentioned the address problem. I've mentioned how you have to do some of these calculations in a manner that you don't have the context that is being looked for by other investors, international investors. And then the cost aspect as well. So it's quite expensive. Even if I'm raising a 44 million or I'm raising a $200 million bond, or a 1 billion bond. In terms of the process and the cost from the verification aspect, it's still expensive for ordinary corporates to do that. Hence, we normally get a lot more from a government sovereign kind of bonds than having it from a corporate bonds. But the opportunity available means that we need to have a lot more corporate issuers, a lot more institutional issuers than sovereign issuers. So those are the, so do we have the opportunities? Yes. I think we are growing. So I'll give you a typical example. Recently, I visited a company that does, it's almost a 100 billion manufacturing company, outskirts of Accra, employs almost 5,000 to 6,000 people in terms of where they are and the employment, jobs they've created and jobs they've retained, quite high. I realized that one of their main problems is the electricity they're using to generate, to do the manufacturing. So my conversation was that, why don't we go into solar? And the first thing is, solar for that size of manufacturing business will cost him almost $10 million. The impact of that capital investment in that business is very high. The first action is, okay, would you as a bank give me a $10 million? You can't pay because then it's going to have an... So the first thing is, okay, we need to look for funding to support this social sustainability business that he's doing because he's impacting jobs, he's retaining jobs, employing youth, a lot of women. It's a soya production business, so where they get the soya from in in various places, the Outgrower project. So this is a typical company that if you bring to a certain issuer for them to raise funds for, it shouldn't be a problem. But if as a bank to do this for this person, I also means that I had to go and issue my own sustainability bond, then it's a problem. So those are the little things that these are the big issues that we're confronting with. And like I said, the demand is available. There are about 10 of these companies in Accra and in Ghana that we can be able to use sustainability financing to support and help them to continue the impact work they are doing.
Thank you for that perspective. And perhaps, Manuel, over to you. In Latin America, you've also had the added challenge of local taxonomies versus the global principles. So maybe same question to you on barriers and opportunities, but also how are you able to bridge that gap, and what do you think perhaps others could learn from that experience?
Sure. So yes, there's been multiple cases of new local taxonomies. I think the whole region itself has seen the importance of local taxonomies, specifically for issuers to have scientific-based and structured frameworks in order to identify sustainable investment opportunities. But I think that the logic behind multiple or even local taxonomies is not to replace the principles. It's to complement it by incorporating specific issues or factors or variables that are from that specific geography. It's important, obviously, that the taxonomy has to be, I would say, have global credibility, but that it's able to operate or be usable in that country. There have been efforts, I would say, in terms of the whole region. For example, several years ago, a common framework for sustainable finance taxonomies was published. It was co-led by multiple MDBs as well as international organizations. But the idea behind that publication was not to make a regional taxonomy for Latin America and the Caribbean. It was more to create taxonomies or support taxonomies that are compatible between each other. Meaning that the idea is not to have a region that is fragmented with different taxonomies, but also to support cross-border investments. So that publication, that was the logic behind it. And like I said, these taxonomies, you have the cases of Colombia, Brazil, Chile. The idea is not to replace the principles, but to enhance it in some specific ways, especially in sectors that are extremely important for those countries.
Thank you. And maybe over to Amaury from the macroeconomic perspective. Do you feel that sustainable finance and capital markets in general are becoming more important because of the changes in ODA that we've been seeing? So are issuers going to be forced to do more in that area?
Good question. I would say, looking at the figure, the link does not seem direct. The correlation is not completely direct. ODA is decreasing basically since 2023. Yes, in 2023, we've seen an increase by 50% of sustainable bonds issued in the emerging markets, but in 2025, which was also annus horribilis for ODA, the volumes didn't follow. So there is clearly no mathematical correlation. Now, on the other hand, for sure, there is some natural transition here between ODA to market condition financing. And by the way, it's the role of development agencies to help emerging markets to switch from ODA to market condition financing, and we do it at AFD, and we've supported some emerging market players, not sovereigns, but usually institutions, financial institutions, to go onto the label bond market. So there's a natural transition, but for a long time for countries, it remains useful to be on both legs. I would say that it's like label bonds is like loneliness. You'd better experience it by choice than by necessity. So looking at that picture now, if you're asking what is really driving the increase, I think that now in most emerging markets, governments have clearer and easier to explain public policies in terms of energy transition, but also in terms of human capital, health and education, and that's of course a very good purpose to finance by label bonds. So I would say that the greater engagement of governments in those domains like energy transition and human capital is clearly a factor for increase. Another one I can see is the greater transparency and the better standards that the market has elaborated. So it's now becoming clearer for an issuer and for an investor to agree on what should be financed by label bonds. And the third factor is certainly back to the first question, the credit risk. In fact, overall, if you look since 2019 on emerging market issuers, they are not so numerous in the emerging market sphere. After all, there are very little of them for which the risk has deteriorated. I counted 6 of them yesterday, looking at spreads, just based on the spreads on the markets. So naturally, because the risk is improving, also there is more space for label bonds.
Thank you. Perhaps back to you, Pro. When you talked, you mentioned a seemingly small detail that you have observed in that project, and you mentioned this has such an effect, the realities on the ground have such an effect on the overall programs. Do you feel that investors sufficiently recognize, do you feel that international standard-setting bodies, such as the principles, sufficiently recognize those realities on the ground, or do we need to align our expectations?
I think they do. We still have a lot more work to do, but I think we are on the right track. For instance, sometimes we work with IFC, certain times, and just because you want to be able to, like I said, using the local nuance, the context as it is, to be able to create that, what you consider as initial impact before the main agenda or the main one. So for instance, if I want to start a whole rural solar project for an environmental purposes, first being able to create that economic activity in that rural space is important. So you start looking at how many women are in business, how many women entrepreneurs am I supporting, how many kids are we keeping in school in that rural space, so that you avoid a certain urbanization or urban migration. So there's a little bit more context now being applied by investors into how they hold issuers in Africa accountable. So I also think that there are a lot more sovereign framework as well that also seek to protect some investors. So the stringent disclosures and the reporting frameworks that has been instituted by sovereign just to ensure that investors have the confidence in what they bring to bear. So we still have a lot more work to do. And for me, I see those work also around, like I mentioned, what matters most in what time. What should and how do we get the confidence that how funds are being deployed, or how funds, the impact the funds are supposed to be created, and getting it back. It's done in a manner that is not transparent. Hence, the sovereign, the platforms like the Ghana Stock Exchange, they're working with the international financing bodies and other partners. So yes, we have seen improvement, but I believe that there's still a lot more work. And the principles as a guideline and the principle that enables the local taxonomy development will also help a lot.
Thank you. Rachel, perhaps we can hear your perspective. Pearl talked about the impact story. She talked about the credibility. Do you think that investors are aware of the realities on the ground? Do they rely too much on the impact reporting? Do investors look the same way at emerging market sustainable bonds?
I think when we assess the credibility of EM sustainable bonds, we do appreciate the challenges that there are and try to take a slightly different approach. I think for us, what's important about assessing credibility here is looking at transparency. We really need to see that issuers aren't just talking the talk, but they are walking the walk. And we understand the challenges, and therefore there are other ways of trying to evaluate that from our perspective. I think we can also move a little bit away from numbers and more to narratives in the EM context. It's difficult to gather all of that data, and we do need it because our end clients are requiring that at the portfolio level for us to report and aggregate. So that standardization is needed, but we understand there's a longer glide path to achieving that standardization. And so particularly in an EM context, it's really helpful for us as investors to receive case studies, qualitative impact reporting, and the principles do highlight this in the impact reporting handbook, to not underestimate the power of qualitative reporting to bring some of these real world outcomes to life. And that's also really important for our end clients. And so I think that's an area where we're really focusing on. Engagement is also a key tool to evaluating some of that, where maybe data collection is quite difficult. And so where there is good investor communication with issuers, I think it's also very useful for us to continue evaluating these issuances and really thinking about them in their context and not beyond that.
Perhaps kind of we're getting towards the end of the panel, looking ahead. Manuel, where do you see the opportunities for growth if you're looking from the Latin American perspective? Different issuers such as corporates, themes such as transition finance, where are the biggest pockets of opportunities for growth?
Yeah, just looking at Latin America and the Caribbean, I think in terms of growth, what is needed is kind of enhancing the scalability of sustainable finance, going beyond the sectors that are relatively already established and just focusing on the sectors that have the highest financing gap. Now towards the future, I would say obviously adaptation and resilience is one of those sectors that, as you know, Latin America and the Caribbean is one of the regions that is most affected by climate change. In terms of those type of financing, demand is still very strong and it will continue. The other is obviously transition finance. Obviously, we've seen recent initiatives from ICMA. Hopefully, that will translate into more emerging markets using transitional finance. For that, obviously, it's very important that the issuer have a credible transition strategy, not just issuing these instruments, but an overall transition strategy, which will give investors confidence. And I think one of the most, I would say, important barriers for sustainable finance to continue to grow is the development of local markets. Without that, it's very hard for issuers to continue to issue sustainable finance instruments in different currencies because of the overall FX risks that they have. So if you look at the region of Latin America and the Caribbean specifically, sustainable finance growth has to go hand in hand with local market development, local currency markets.
Thank you. And perhaps a final question to all our participants. The principles have evolved quite a lot over the years, most recently, as you mentioned, also into transition. Have the principles reached maturity, or what do we need to do? How do we need to evolve to better support sustainable finance, specifically in emerging markets? So who should we start with? Amaury?
Well, clearly, I think the answer is both, at least on my side. I mean, we've clearly reached a maturity as compared to what we had in the beginning, and but still there are some room for improvement. I think the point on local currency is key, at least from a risk point of view. The forex exposure is clearly a subject. On our side, we're also working on a topic that has been less discussed today, which is biodiversity and nature, nature-based, nature-related services that are important for economies, especially emerging economies that are dependent on agriculture. So there's clearly in the future years to come questions about biodiversity and how to maintain a certain level of biodiversity. That would something that the principles could look at as well.
Pearl?
Yes, so I look at it from this perspective. Yes, maturity important because then we know where we pivot from. So I think that is looking at the recent work, which I was part of the social bond amendment principles that we're doing. I consider that as a pivoting from a certain maturity to now bringing a little bit more perspective into where we see a lot more opportunity, a lot more gaps. And this is, for me, one thing that will then benefit emerging markets. And if I use Africa as an example, because just by looking at adopting certain standardized reporting framework into how we able to create a transparency for investors, it's important. Hence, that maturity has helped us to be where we are now, and then is a bit of bringing a lot more flexibility and perspective and standardization to some extent to where we are pivoting to. So that's what I would say.
Rachel?
I think echoing what Pearl's mentioned is we need to keep the principles flexible, but try and achieve that goal of standardization. And there's a risk of evolving so far that you become a prescriptive, effectively regulation. And that's not the goal here. And so we'd like to avoid that. And I think the principles can really evolve by continuing the thematic guidance, again, keeping it as guidance, and really focusing on highlighting to issuers the link that investors care about to the overall sustainability strategy. As I mentioned earlier, that has prevented us from buying bonds before, and so it's really important for us that that is highlighted in the framework and evidenced when the projects are then reported on how that links back to the overall strategy.
Manuel?
I would say the principles has matured as a foundation, but it has to continue to evolve in order for it to remain practical and inclusive for emerging markets. Yeah, I mean, I think pretty much everything has been mentioned, but yeah, flexibility, specifically on the most important constraints in emerging markets, such as data gap and reporting constraints. Not meaning that it should not be as rigorous as it is, but just to identify certain flexibility in those points.
Thank you so much. I'm not sure if we have time for Q&A. I apologize to the audience. I've overwhelmed with questions. Thank you so much to the panelists. It's been a fascinating discussion.
Thank you.
Thank you so much for coming today.